If you build $1 million nest egg but lose 25% of it to taxes in retirement, that is a $250,000 mistake. Most people choose their retirement account without realizing they are making that exact trade. Both the 401k and the Roth IRA are highly effective vehicles for building wealth, but they operate on completely inverted tax timelines. The standard error is passive acceptance. Most of us just check whatever default box our HR department sets up without actually looking at the underlying mechanics. By doing that, you risk trapping yourself in a suboptimal tax burden right when you need that money the most, at retirement. To fix this, we have to pull both accounts apart, put them side by side, and find the exact mathematical fit for your specific income profile. Understanding the specific tax trade-off is the single most important factor in keeping the wealth you earn, instead of handing a huge percentage of it back to the IRS. Let's start with the 401k. At its core, this is a retirement account sponsored directly by your employer, funded with pre-tax dollars. That pre-tax designation gives you an immediate benefit. If you earn $5,000 a month and contribute $500, that money is routed directly into your 401k before taxes are calculated. Your taxable income shrinks to $4,500, giving you an immediate tax discount today. And that bucket has a lot of room. For 2025, the IRS allows you to push up to $23,500 into this account every single year. But the real draw is the employer match. This is essentially free corporate capital. If your company offers a 50% match on a 6% contribution, they are dropping an additional 50 cents into your account for every dollar you invest. That is an instant guaranteed return on your money. But there are strict trade-offs. Because you didn't pay taxes up front, the IRS will tax every dollar you withdraw in retirement. You'll face steep penalties if you pull that money out before age 59 and a half. And your investment options are locked into a small menu of funds chosen by your company. In short, the 401k trades future tax liability and investment freedom for massive immediate capacity and the highest possible upfront return on investment. The Roth IRA sits on the complete opposite end of the spectrum. This is an individual retirement account you open entirely on your own, completely detached from your employer. The upfront tax consequence is blunt. You fund a Roth IRA with after-tax money. You pay your taxes first, meaning you get absolutely zero deductions today. But here is the core advantage of that structure. As this chart shows, once your after-tax money is inside the account, every dollar of growth over the next few decades compounds completely tax-free. When you reach retirement, you pull those profits out and the government gets nothing. Zero taxes on the growth, zero taxes on the withdrawals. The entire final balance flows directly to you. The catch is the strict limitations. The government caps Roth IRA contributions at just $7,000 a year, and if your income exceeds a certain ceiling, like $161,000 for a single earner, you are locked out of contributing directly. However, the trade-off for those limits is extreme flexibility. You can buy thousands of individual stocks and ETFs. You can withdraw your initial contributions at any time without penalty, and there are no required minimum withdrawals forcing you to take money out. The Roth IRA sacrifices immediate tax breaks and high capacity in exchange for total investor control and absolute, untouchable future wealth. We can map these accounts directly against each other. This matrix shows the inverted tax treatments. The 401k gives you a tax break right now, while the Roth IRA gives you that break later in retirement. When we look at annual capacity, the 401k allows for $23,500 compared to just $7,000. And when weighing benefits, the 401k provides free money through the employer match, while the Roth IRA offers total investment freedom. Pitting them head-to-head shows that these accounts solve different problems at different stages of your career. Most investors find the highest efficiency by stacking these accounts in a specific three-step sequence. Step 1. Look at this waterfall diagram. You route your liquid capital into your 401k, but only up to the exact percentage your employer matches. You stop the flow exactly at that limit to secure the 100% instant return. Step 2. You take the rest of your investing capital and redirect it to fully max out your Roth IRA at $7,000 a year, securing that long-term tax-free growth. Step 3. Only after the Roth is completely maxed out do you route the flow back to the 401k, pouring in any remaining capital to utilize that massive $23,500 remaining capacity. Executing this specific sequence creates a highly efficient financial engine. You capture every dollar of free corporate money on the front end while securing decades of tax-free compounding on the back end. Of course, if you don't have the capital to run the full waterfall strategy yet, you can choose a single account based on your current financial position. If you are a high-income earner, the 401k is often the priority. You need immediate tax relief today, and this account shelters your current wealth while offering the high contribution limits you require. If you are young or in a lower tax bracket today, the math points to the Roth IRA. You can lock in your currently cheap tax rate and enjoy the penalty-free, tax-free wealth decades from now. And if your employer simply doesn't offer a match at all, the 401k loses its biggest advantage. In that case, starting with the Roth IRA provides far superior investment control. Whatever your specific math dictates, time is the primary variable. Every month you delay making this choice represents permanent, unrecoverable lost compound interest. Log into your portal, identify the account that fits your current